Good evening, I'm Marvin Brown, and this is News Now Influence. In today's top story, the South African Reserve Bank has made a key decision to lower the repo rate by 25 basis points, bringing it down to 8%. This marks the first rate cut in 4 years, signaling a major shift in the country's monetary policy. We'll take a look at what this decision means for the economy and for you at home. What exactly is the repo rate? The repo rate refers to the interest rate at which the South African Reserve Bank, or SARB, lends money to commercial banks. This is one of the central bank's main tools for controlling inflation and managing economic growth. By changing the repo rate, the SARB can influence borrowing costs, which in turn affects consumer spending and investment. Immediate effects of the rate cut. One of the first things to notice is that this reduction will lower borrowing costs. This means that home loans, car loans, and even business loans will become slightly cheaper for South Africans. The SARB's goal here is to encourage more borrowing, spending, and investment, which could help to boost the country's economic activity. This move is seen as a way to stimulate economic growth. With cheaper loans, both consumers and businesses are more likely to spend and invest, increasing the demand for goods and services. This, in turn, could potentially boost production and even create jobs. However, while borrowers stand to gain, savers might not be so lucky. Lower interest rates mean that returns on savings accounts and fixed deposits may decrease, which could be bad news for people who rely on interest income from their savings. Broader economic impact now. Let's talk about inflation. One of the key reasons for changing the repo rate is to control inflation. By cutting the rate, the SARB is signaling that it is comfortable with current inflation levels and is focused on boosting economic growth. However, there's a possibility that, if the economy grows too quickly, inflation could rise in the future. There's also the question of how this affects the value of the South African rand. A lower repo rate might weaken the currency, making South African exports cheaper and more competitive on the global market. However, the downside is that imports may become more expensive, which could lead to higher inflation over time. Another important factor is consumer confidence. A repo rate cut can send a positive message to consumers, letting them know that the Reserve Bank is actively supporting the economy. Increased confidence can result in more spending, which would help stimulate growth even further. Long-term considerations. While the immediate benefits of this rate cut seem clear, there are some long-term risks. One concern is that lower interest rates could lead to higher levels of debt as consumers and businesses take on more loans. Borrowers need to manage their debt wisely to avoid financial trouble in the future. The SARB also has to keep an eye on maintaining economic stability. If rates are kept low for too long, there's a risk of creating asset bubbles or financial instability. Therefore, the central bank will need to carefully balance its policies. In conclusion, the South African Reserve Bank's decision to cut the repo rate by 25 basis points is a strategic move at supporting the economy. While it offers lower borrowing costs and could boost spending, the long-term impacts will require close monitoring to maintain stability. I'm Marvin Brown, and that's your news update. Stay tuned for more on News Now Influence.